Yo, welcome back to another episode of Invest in You. In this video, we'll be going over what portfolio diversification is. I'll be telling you about the portfolio that I think is a very good diversified portfolio that is robust and strong to handle anything and will always at least try and give you a positive growth. Okay, so what a diversified portfolio is it's a portfolio that can resist anything the market throws at it, and it will still strive to be a positive growth portfolio. So this means not having all your eggs in one basket. Everyone knows that saying, so it's the same with your investing portfolio. You don't want your portfolio heavily focused on one industry. You want it looking at various industries so that if one does bad, the other one can save your bum. Please, always, a diversified portfolio does not guarantee that you will not do bad. The only thing about a diversified portfolio is that it creates that safety net so that if a certain industry does bad, the chances are that other industry will benefit from it. I mean, look at the COVID and the pandemic situation. COVID home-based working stocks did very well. And then your typical commercial or stuff that normally was very dependent on foot traffic started struggling. So that's why the airplane stocks really struggled, and the leisure and the tourism stocks struggled. But then stocks like Zoom and all your tech stocks and your gaming stocks, they started doing well. Diversified portfolios are the reason why ETFs are so successful. ETFs or mutual funds are pretty much just little pockets of diversified portfolios. So that's why the great thing about buying an ETF is you're kind of buying a diversified portfolio. So yes, you do get ETFs that aren't diversified that much, so they'll only focus on one industry, and then those type of ETFs you need to watch out for, and that's why you normally need to get that ETF and another one. So let's get into it. The first thing in my eyes of a good diversified portfolio is the weighting of where most of your money goes. So for me, that is 70% of your total money goes to USD stock market. So that means I dedicate 70% to my USD market and 20% to emerging markets, and the other 10% I dedicate to cryptocurrency and cash. The 20% to emerging markets. So South Africa is considered an emerging market. So that's why for that 20% breakup, what I do is I put 10% towards the JSE, 5% towards the Australian market. That's just because that on EasyEquities we have access to that, and then the other 5% I very much like pushing into a China ETF or a Japan or Asia ETF. And then obviously that last 10% for cryptocurrency and cash. I'll make a video on cryptocurrency at some point, but it is definitely one to look at, especially if you look at where the price is currently. Once you have your money weighting dedicated to a certain type of exchanges, now you need to decide what type of portfolio you're going to do. So I have three options of portfolios that I like to approach. So option one, it's a higher risk but a higher growth potential option. So for this, I dedicate 90% of my funds, I dedicate to individual stocks, and 10% I dedicate to ETFs. Of that 10% of ETFs, I would say a good amount of ETFs to have is about 5. You're not dedicating a lot of money to it, so rather just stick to the 5 ETFs. Then the option 2, so now this one is a lot more safe and anchored, but your growth potential is a bit less. So the second option, and this is the option I started with when I started investing. This is what my portfolio pretty much looked like when I started buying into investing. It was 50% ETFs and 50% individual stocks. So this gives you a good way. 50% of your portfolio is definitely very well diversified. And then the other 50% of your money is going to individual stocks that you like, that you're giving that little extra secret sauce to just spice up your portfolio a bit and get that growth. For that 50% ETFs, I would say a good number of ETFs to hold is about 10, because you now have a bit more money, so you can diversify even more if you want. I mean, it doesn't have to be 10, it can be less than 10, but that's a good target to aim for. Then the third option is by far the safest one, but the chances of you growing rapidly is not that high. You will most likely do very well. So the S&P 500 typically year over year gets about 9 to 10 to 14% growth. So you're kind of assured of that in a sense if the S&P 500 keeps doing what it does and you reinvest your dividends. So for this one, you would dedicate 100% of your funds to ETFs, so buying no individual stocks. And then what you would do later down the line, so after 5-10 years, you've now experienced your ETFs, you've grown your money steadily and securely, and now you start, like you've done your research, you know what stocks work in those ETFs, what ones you like, then you buy the individual stocks within that. So you start pulling out money, or for the money you put in then goes to those individual stocks. So you only start growing that high growth potential later on. But as I said, the chances of you then growing exponentially fast is a lot less, but it is a lot more safer. So I would say if you're using money to invest that you are very secure about and you don't want to take that high of a risk, start off with those 100% ETF portfolio. Now, diversification also means you need to own different types of stocks, meaning in different industries, whether it be defensive, cyclical, growth, value, dividend. Now, yes, I know you get bonds and you get commodities and those things. I personally am not a fan of investing into bonds. I do know exactly the appeal for them. It's just, I think it's a very old way of investing, and I think I can get a much better return from other things. But definitely have a look at bonds, because government bonds, you can very often be assured of getting what if they have that fixed rate. Commodities, they are good, but I'm very wary because commodities I see in the same pool as Forex a lot of the times. For instance, if you had to buy a gold commodity, if you look at what the gold's been doing in the past few months, it's been going up and down, skyrocketing, then plummeting, and I'm not a fan of that. So a commodity just tries and tracks those indexes, and I just don't like the volatility. Now, as I said, the diversification comes in with the industries you invest in. So I'm going to tell you guys my ideal percentage breakup into each industry. So I can assure you that my portfolio looks a lot like these percentage breakups. But now remember, you can do whatever you want. Like use it, don't use it, whatever. But these percentages is what I think is a good breakup of what your portfolio could look like. The biggest weighting in this portfolio, this ideal portfolio, I would say is towards tech. This whole 4.0 industrial revolution industry. I mean, everything you use today has tech. Think about it. Literally, even your dishwasher has tech in it. Okay? So everything, you're using tech right now watching this. So I dedicate 35% of my funds in my portfolio towards tech companies. I mainly focus on anything automation related, cloud-based, or anything advertising or internet as a service. Anything in that direction. Then the next one, which kind of falls together with tech a lot of the times, like if you look at Tesla, I see Tesla as a tech company, so is 10% towards renewable energy. And these companies are definitely the thing of the future. Your tech and renewable energy goes hand in hand. Then the next two categories is consumer defensive and consumer cyclical. I dedicate 10% to both of those industries, just because consumer cyclical, we know it's up and down, it moves with the market, if there's a recession, if there's not, and consumer defensive is more robust, and that's why you're kind of assured of those types, but nowadays also not that assured. Then I dedicate 10% to a future venture. So what I mean by future venture is, this is any industry that you think will be the next big thing, the next big rail boom, or the next big tech boom. So find a company, find an industry that you really think is the next. So for me, that would be anything in the line of automation or fintech. Anything in that industry, that's my future venture. Then you would definitely dedicate at least 5% to healthcare stocks. I mean, especially with the vaccine and stuff coming out now, and healthcare stocks typically have a very good potential if they find out something great, because they patent their discoveries, and then you're assured of a 5-year growth on those types of developments. Finally, 10% towards real estate. Now, my real estate is not physical brick and mortar buying. My real estate percentage lies in EasyEquities and also into REITs. So companies like GrowthPoint or Realty Income or Baldwin. So definitely dedicate some of that. That 10% that's left over, that is your buffer. So either you can have 10% cash into your portfolio, or you can have 10% pushed into cryptocurrency, or you can use that 10% and divide it up into the industries that you see that are doing well. So use it, don't use it. That is my diversified portfolio. It's quite a mouthful, but that is just the breakup. I mean, I can go into depths about every single stock and industry to look at, but now you have a skeleton framework to go off of, and you can go use it or not. And stick around for the end about some crazy Tesla news. Okay, it happened. Tesla got added to the S&P 500. Guys, now this is crazy. I mean, this is the first time in history that it's taking so long for a company to be actually added onto the S&P 500. So what I mean by that is, typically when a company got announced to be added to the S&P 500, it would take anything from 6 to 14 days for it actually, from the announcement date, to be. Now, with Tesla, it's taking 35 days. That is the longest any company. And this just shows you the magnitude of the addition of this company to the S&P 500. I mean, there's a lot of things, just the sheer size of the addition creates a question of, will there actually be enough shares out there that all these ETF and mutual funds can buy up in order to equal the S&P 500 track list? And that is obviously a good thing for if you're a Tesla investor, because if all the shares get bought up, demand is very, very high. So there goes the price. So definitely one of the best things that could have happened. It should have happened a long time ago,